Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. We're going to take a look at some foreclosure statistics. If you are in the real estate market, one of the things that we are undoubtedly going to hear a lot about in the very near future, if not already, is foreclosures are spiking. Foreclosures are a problem, delinquencies, all of those things. We're likely going to hear that foreclosures will probably lead to price crashes. So what I thought I would do is just look at the actual information. Having been an investor who bought some foreclosures, I could tell you you're absolutely right. Foreclosures, short sales typically come with a significant discount. They are often in a distressed state, so they are most likely not perfect. In fact, I don't remember buying a foreclosed property that didn't require tens of thousands of dollars in cleanup and repair. But that said, I think it is important to look at the actual information. And we're going to do that by looking at some information from Black Knight. I like to use Black Knight because, A, they track this stuff, they have historical relevance, and they don't have a bias. Black Knight is not a real estate organization that will tell you prices are going up, prices are going up. They're not in the real estate crash camp. Prices going down, prices going down. They're more like, hey, here's the data. Here's the seasonality. Here's the historical information. So I like to look at Black Knight because they are non-biased. So let's take a look. Again, this comes from an article from someone I follow on Twitter. We'll give him his props real quick. Calculated Risk is the blog. It is, why am I not seeing his name? One sec. I will go to my phone because I just got it. It's Bill McBride. Bill McBride. Sorry, I should have had that handy. Bill McBride. So again, we're looking at mortgage delinquency rates for July. It was just published on the 24th. So this is like 3 hours old. So the first thing to look at is the national delinquency rate. Delinquency is missed a payment. It is not only missed, it doesn't have to be foreclosure. So we're looking at early in the process. So delinquency rate is 2.89% in July. There was a 4% increase in early delinquencies. Think missed one payment, missed two. It is 14 basis points higher than a record low of May. So it is still statistically relevant at a record low. Serious delinquencies. These are 3 months. Remember, folks, we've talked about the foreclosure process. It's not even legal to start until you're 3 months down, hence called serious delinquent. Loans that are 90 more days past due but not yet active in foreclosure has pulled back after worsening for the first time in 22 months. So it got a little worse in June, but got better in July. Really what we're seeing here, folks, is banks are acting different. As an investor and buyer through the last crisis, I could tell you this is not how banks operated last time. The number of seriously delinquent loans curing, which means getting fixed or addressed, has dropped steadily over the recent months after peaking at 104, now down to 58. So they're curing slower total volumes. But again, as you'll see, the base is actually much smaller as well. Foreclosure starts retreated 25%. I'll say that again. Foreclosures down 25% from the June total of 17 grand. 17,000, folks. 17,000. We used to do 200,000. We are 55% below pre-pandemic levels, equating to just 3%. So again, not the big wave that people keep talking about, but that doesn't mean they won't keep talking. We are still at record lows. Widespread moratoriums for forbearance protections. Number of loans active foreclosure declined slightly to 6,000. 6,000. Prepayment activity dropped another 18% in July, is down 67%. That's just refis and sales. So again, Black Knight is basically saying, so here's the math right here. Here's their chart. We'll just close with this. So we have July of 22, June of 22, July of 21, July of 20. So we can go back and look at last month, last year, and 2 years ago. The delinquency rate is slightly higher than last month, right? 2.89, but significantly lower than the pandemic. Foreclosures are better. They went down slightly, not just barely 0.5%. Properties that are delinquent, basically 1.5 million. We were as high as almost 3.7 million in July of 2020. Properties in foreclosure, 184,000. Just 184,000. So total properties in trouble, about 1.7 million. So again, folks, you've undoubtedly seen articles about foreclosures up 400%, 100%. We're talking very small numbers. There will undoubtedly be an increase in foreclosures. I'm not here to tell you it won't be, but they will be double, triple digit, 100%, 150% off very, very small numbers. As somebody who was buying in the last crisis, the big difference, there's two big differences. One, banks are fundamentally different. In the last crisis, if you were 90%, 90 days late, you were over 90% likely to be foreclosed. Today, you get 90 days late, you're likely to get a loan workout or a forbearance. Banks will just simply not foreclose like last time. I'm sorry. It's not going to be the wave that we all want or hope for. Second, the loan product. Last time the loan was toxic. These teaser rates would reset and the loan payments would explode. Today, if you get in trouble, you probably have equity, but if you don't have equity, you probably have a fixed rate mortgage, which is probably valuable to someone. So there will be more foreclosures, undoubtedly. There will be more pain. There will be more job losses. It's just not going to be 2010 and 2011 all over again. So let me know what you think. This, again, is sourced from Black Knight, Black Knight's data. Take care of yourself. Have a wonderful day.